get the views of Steen Jakobsen, who's chief economist at Saxo Bank. He joins us now from Hellerup in Denmark. Steen, great to have you on the program. What can you tell us about what we should expect from today's trading day? Is this rally going to continue? Is it going to be fleeting?
The market clearly wants the path of least resistance. They seem to be very happy with having any deal that is just basically creating more debt to deal with that. I think it's the wrong approach. I think it's not even going to fly in Germany. But for now, the market just want to be basing everything on hope. But in my opinion, we haven't got a best solution. We don't even have a second best solution. We are going down a one-way street which ends with a wall.
You're talking about hopes that the ECB will step in and buy covered bonds, cut rates, effectively take the crisis into its hands some more and bail Europe out. You say that's the wrong approach. What is the right approach?
Well, the right approach would be to embrace a crisis, would be to initiate the deleveraging, to let Greece go default. I mean, Greece going default will be the most pre-announced event in world history of finance. Unlike Lehman, which everyone seems to be comparing it to, don't forget Lehman was a surprise to the whole system. The fact that they let it go on its own was a big thing. Greece has been pre-announced. The banking system is still the Achilles heel of this system. And creating some sort of SPV vehicle with infinite financing from the ECB is just one way of going to monetization, a quantitative easing in Europe following the steps of Japan, Switzerland, US, and next month the UK.
But Steen,
so basically all roads leads to monetization.
If Greece does default, the EU's got to be prepared. They've got to be ready to bail out banks, don't they? I mean, what's preventing this default from taking place?
I think it's the whole concept of contagion. People seem to think that contagion is an economic concept. Contagion is some policymakers' excuse for why they're not implementing austerity or implementing fiscal cuts. I'm just back from both Spain and Portugal, and the excuse I keep hearing on the streets in these two countries is our contagion. If Greece goes, we have problems. I mean, let's face it, these countries has problems on their own. The dire strait they're in is due to their own economic policy and their inability to create growth, productivity, and doing something long term. So, you know, I think to a large extent this contagion risk is much, much smaller. What I'm trying to say really is that Greece defaulting is pre-announced as being the biggest potential risk for the markets. I mean, if we all already are, I mean, the market is having a 95% probability of Greece defaulting. How can that be such a big surprise? I actually think letting Greece default, leaving the system, recapitalizing in the banks as much as you need not through a leveraged vehicle, but through actual capital will be a much better solution.
All right, so let's just talk about the markets for a moment, because you've highlighted this sell-off in gold, which came along with a sell-off in metals and in other commodities, and compared it to 2008. How does it compare?
Well, first of all, I think everyone who's in the commodity market knows that any bull cycle has a 40 to 50% correction in it. If this is the 40 to 50% correction, we've done about 20–25%, and there is still further to go. But it doesn't change the fact, as I just stated, that there's plenty of reason to buy gold. But as you are in commodities, you need to realize these have huge cycles, even inside the bull cycle. And secondly, I think the reason we saw the sell-off in gold is clearly that people are nervous about the redemption coming up in funds. A couple of very big funds are, you know, rumored, if not reporting results, which is dismal. So market is getting nervous, and it's classic when you're in this phase, which I call maximum intervention, where we're really not in event risk, we are in announcement risk from policy.
Steen, what do you make of the regulatory environment at the moment, the latest of which the regulators now targeting the auditors?
I would say it's going to be extremely difficult to run a small bank, and it's going to be extremely expensive to run a big bank. I think that is the trend clearly. I was very struck by the FT's article this weekend about the Tobin tax being further ahead than I actually thought it would be. So I think the regulatory framework, which is classic in economic history, is there's going to be too much of it at the wrong time.
All right. I just want to take you through, Steen, what you say the world is left with in terms of its options. So just bear with me for a moment. You talk about three options. One being Japanization. That means we'd better get used to deflation and a lack of momentum in the economy. Then we should brace ourselves for another crisis. Steen Jakobsen, you think that taking our medicine is not such a bad solution to this one. And finally, monetization. Banks aren't likely to lend money, so we need to come up with another solution in order to replace them. So which option are we headed for now?
Well, if we look at the Eurozone debt crisis, Europe history is always the one of monetization, the same for the US. So I think the 70% likelihood is that we're going to have what I call extend and pretend scenarios, which is that we extend buying time and we pretend we have a credible solution. I think the market in that environment is betting that Germany will side on solidarity rather than discipline. I happen personally to disagree with that. I think the German opinion, in particularly Bundesbank and even Asmussen, is not supporting this, but that is clearly the most likely. My point on Crisis 2.0 is that the only time where you can actually talk face-to-face with a rational politician, a rational banker, is at the time of distress. I think a Crisis 2.0 would be a great opportunity to create the framework for going forward, basically deleveraging the society, making proper regulations, as you just talked about, and embracing the European project if you really want to have a solution to that.
So you're talking about extend and pretend policies from governments leading to another crisis, and then in that crisis, in the depths of that crisis, we'll get a solution. Japanization? Exactly. When does that happen? How does that happen?
Well, it depends how much the market is going to buy these balloons coming out of the floating balloons that's coming out. I mean, now we don't have one plan on the table. We have 4 or 5 over the weekend that are coming out, different ways of doing SPVs and vice versa. But I think we have to realize at the market that ultimately we have a mismatch between the debt, which needs to be refinanced, and the capital available to finance this. And creating more debt is not a solution in that equation, not even for an accountant.
All right, Steen Jakobsen,
I think clearly
we have to leave it there. Chief economist at Saxo Bank.